for his views on that rate rise and plenty more, including all the latest that the bond market's watching. Jim Stening joins me now from Fixed Securities. Jim, good to have you in studio again. Thank you. And we had that RBNZ rate hike come through. It seems that Alan Bollard's very cautious about further hikes, and he's been stressing the difference between New Zealand and Australia. What's just your initial reaction to that rate hike today?
Yeah, I think it's sending a message. I think you know, it's certainly one that I think has had a lot of talk about it. But it's definitely in times like this, it's not something that you want to initiate an aggressive tightening cycle. I think that's what he's saying. I think that, you know, need to watch unfolding developments, but we have to take a stitch in time, I suppose. And
so central banks that are looking at tightening rates, they're still really watching that European situation and just deciding. So. I mean, what's the question they're trying to answer though? Is it how much Asia gets impacted, or?
Well, look, I guess I mean global growth or world growth is, I suppose, what people are focusing on. Obviously, there's this. I suppose developing theme that Australia's a bit, or this sector's, this area is a little immune to European slowdown because of the Chinese economy and Asian growth. But yeah, look, I think this is certainly disruptive. This information that's coming out of Europe, as I said before, it's just this ongoing saga, this ongoing story that's dragging on sentiment.
It does seem that you've got this gulf between the countries looking at raising rates, and already this year I think we've had there's just as a couple: Australia, India, Malaysia, Peru, Israel, Canada recently, and now New Zealand, and actually Brazil today as well. I just saw in the breaking news wires too. So you've got that group raising rates already, but then it just seems that, I mean, the UK, the US, those European nations, they're way off increasing interest rates.
Yeah, it's very unlikely we're going to see any change from the US commentary. Bernanke's, you know, keeping rates low for an extended period of time. That's there to stay, probably. But yeah, look, I think you know, the important thing is that in these economies that are tightening rates, really what they've had in place is emergency settings. You know, we're particularly familiar with that in Australia. Yeah. So it's really just a return to neutral or return to normal, rather than sort of having to deal with the impacts on growth that the larger, like the US economies or the UK economies or the European economies are dealing with.
Do those countries not looking at like raising interest rates even in the near term? I mean, do they start to worry about inflation at some point, knowing that they've still got those emergency settings in place?
Yeah, well, I suppose that does happen. I mean, I suppose that's an indicator that things are starting to grow, but there doesn't seem to be any sign of inflation in those economies at the moment.
In this whole discussion, what are the implications for investors, people looking to put money to work?
Yeah, well, I think what we've seen so far this year, I mean, if you take a look back, we're almost 6 months through the calendar year. I think the performance in risk assets has been very bad, outside of certain commodities. And so I think that you know, it's difficult for investors to embrace risk over the next 6 to 12 months, given that there's a high likelihood that there's going to be a continuation of these types of bombs, if you like, going off, fiscal bombs going off around the world. So I think really we can probably see a continuation of demand for quality fixed income products. So people seeking a safe haven. I mean, gold seems to be a fairly well-favoured safe haven as well.
We heard from the RBA Governor Glenn Stevens, and while the RBNZ raised interest rates today, we look like we're on hold for at least a little bit here. How long do you think, and were there any particular clues, did you think, in the speech yesterday? Yeah,
well, look, I thought it was a very well balanced speech. I think that the thing that I took away from that was that I think the central banks are really focused on this thing that seems to be being called fiscal credibility. Now, I suppose the microscope is on the UK at the moment in terms of their credibility, and I suppose the next 3 to 6 months will be crucial in terms of whether or not they have any credibility or whether they garner credibility. So I think that's really going to be the pivot point for the next 6 to 12 months in managing the various economies around the world.
Something that the RBA Governor Glenn Stevens did speak about was our property market and maybe the fact that it's over leveraged. What did you make of those comments?
Well, I thought it was a very valid comment. I think the point that he was making was that these seem to be long-term structural issues, and he referenced that some of the issues that we're facing in Europe are the result of these long-term what's the word, I suppose, trying to ignore problems. And so I think that what he's recognising is that there may be, an exposure there as far as the Australian economy goes, as far as individuals go, as far as financial institutions go. And he's not saying that that's a great threat or that there's any problems there. But he's saying that it's it's something that needs to be addressed over time. And so I suppose what that sort of translates to in terms of their view, or the people who hold the lever on monetary policy, is that they're more inclined to be hawkish than dovish.
Knowing the Australian debt levels, although he did kind of suggest that at least it's looking a little bit better, and he talked of the fundamental. I think he said the shift that's underway, that he can see that's more than just people reacting to interest rates. There's kind of a change in behaviour he's noticing. That's
right, and I think whilst they recognise that that's what's happened in the past, I think he was very positive about some recent developments that could hopefully become more of a trend, and if so, that would make the economy even more robust. So,
just going back to the countries raising interest rates, and we've mentioned a few of them, all of them seem to say that really now the next decision and the next few decisions depend on what happens out of Europe, and you've suggested that. Just, what's the latest on the sovereign debt crisis that you can see that you've really noticed?
Yeah, well, I think the UK, as I sort of alluded to, is a bit of a test case. I think at the moment the new government is being given some space to implement some fiscal restraint or austerity packages, as we're calling them, and so I think that the market's probably being a little bit indulgent. When you look at the numbers and the task that's sort of in front of that government, and then you look at the structure of that government, it's going to be very interesting being a spectator of that, watching that unfold. I think we've finally got this head-to-head bout with political reality and commercial reality, and so. I think it's going to be very interesting, that playing field. Yeah, and
Fitch was happy to come and rain on the parade the other day. In some ways, in some ways, threatening a downgrade for the UK's rating. Do you think it's quite possible then, given you've outlined how tough it's obviously going to be?
Well, I think it's fortuitous for this government because the rating agencies are giving them the message, and so they can afford to talk very tough. Right. We've got the emergency budget in the UK on the 22nd of June. I think that will be a tough document or a tough discussion. The difference is the implementation and whether or not it can actually happen. I think some of the other major global rating agencies do have the UK on negative watch. Fitch doesn't, but I do think that the rating agencies are certainly signalling their intentions.
What happens if the UK deteriorates? What does it mean for Australia?
Well, I suppose, the impact, it's just an ongoing saga in Europe. I think what tends to happen is that once fiscal credibility is lost in a nation's ability to, or in a nation, then that translates into the private sector, so the banking sector can be affected.
Can I ask you briefly, just to finish off, about APRA and the stress tests that they've undertaken, and as seemingly our banks are looking strong and maybe in better shape than last year. Just give us the update on what APRA announced.
Yeah, well, basically what they've done is they fundamentally look at three things. So they stress test three aspects of a bank, and that is the quality of their loans, their liquidity, and also the impact on their capital structure or their capital ratios. And so it's an extremely rigorous test, and it involves a whole variety of inputs and changes. And basically they're saying that those top 20 banks can withstand the pressures of those events if they occurred. It's an interesting thing, and I think it's a very positive thing. I think it's really important that the regulator is out there informing everyone as to the results with these tests. I think if you cast your mind back to the midst of the crisis in March 2009, when the banking sector, the US regulators ran stress tests over their banking sector, and whether or not that was the turning point or whether it's a coincidence, I think it played a role in comforting people. And so I think it's really important in both times of crisis and non-crisis to be relaying this information. And I think if it's done properly, it can go a long way to sort of easing the transition from government guaranteed to non-government guaranteed deposits.
So that gives reason to be taking away that guarantee?
Yeah, well, as long as people are informed and are comfortable that these are very rigorous tests, then I think that it can certainly help.
But does it help just to do those top 20? I suppose they've got a big share of the market, but should it go beyond that?
You're absolutely right. I mean, I think in terms of assets, that represents the high 90 percentile percentage of all of the banks in the country, the top 20. But there's over 100 approved deposit-taking institutions. I mean, we don't really call them banks anymore. They have banking licences. Now, what does that mean for them? So I think there needs to be a little bit of caution in terms of how that message is communicated.
Great to have you in the studio again, Jim. Thank you very much.
Thank you.
Appreciate your time. That's Jim Stening there from FIG Securities, and good to catch